So I've been thinking lately that I should give an update on GE stock because the company has been going through some pretty big changes and the stock price has also been pretty active, dropping by 12% in September, 10% in October, and 25% in November, but then recovered a tiny amount in December before going on a monstrous rally in January, climbing by 34% in that 1 month alone. But they are still down over 65% in the past 3 years. Needless to say, the stock price has been all over the place. And because they just announced their fiscal 2018 results, I thought it'd be a great time to give an update on the business, on their company, and especially the stock, and let you guys know if I plan on buying the stock anytime soon. So we're gonna do all of that and more in today's video. Make sure you hit the like button if you enjoyed this, and let's get started. What's up everybody, my name is Ale and welcome to my world of stocks. Alright, let's begin the video by doing a quick little recap of their business. Well, in recent history that mostly consisted of segments like power, oil and gas, aviation, healthcare, transportation, appliances, lighting, and GE Capital. But because the company was so horribly mismanaged for so long, several of those saw just as horrible performance, especially their GE Capital segment, which was expanded from just offering finance services to customers so that they could afford some of the expensive products that GE sold, to an overreaching array of services, including things like home mortgages. Of course, this turned out to be a huge mistake once we hit the Great Recession or financial crisis that mostly occurred in 08 and 09, as their GE Capital segment was losing money at an alarming rate and threatened to completely destroy the company. As a result, GE was forced to sell assets, cut their dividends for the first time in history by almost 70%, which was a huge deal because they'd been paying dividends for over 100 years at that time. And this was also the largest dividend cut by an American company in history. And on top of all of that, they even received a government bailout of almost $140 billion. To keep the story short, I'll just say that under their CEO at that time, which was Jeff Immelt, GE was accused of making horrible acquisitions at horrible prices, selling assets at horrible prices, and even buying back shares at horrible prices. To be fair, things were briefly looking up when GE started investing heavily in oil and gas, but that ultimately turned out to be just another mistake to add to the list when oil prices started crashing in 2014 and demand for renewable energies started taking off. And another example of making a poor acquisition at a high price was evident in their acquisition in 2015 of coal and gas turbine specialist Alstom, which was at the time their biggest industrial purchase in history at over $10 billion. And that later led to a gigantic write-down of $23 billion just last year that destroyed their earnings. But I'll show you guys that a little bit later in the video. Of course, this also led to GE combining their oil and gas business with Baker Hughes, which is now known as a GE company, but GE has been selling their stake over the last few months as it looks to refocus their business on other core segments that they believe in, like aviation, renewable energy, and their very large but horribly performing power segment that also consists of some oil and gas components as well. And we'll talk more about the performance of those segments in just a second, but I just quickly want to add that GE sold about a quarter of their stake in Baker Hughes for around $23 a share back in October, which was one of the lowest prices that the stock was trading for in the past few years. Not really something to be too excited about. On the other hand, it did help lower GE's stake in Baker Hughes from around 62% to just 50%, making them less exposed to the oil industry and helping them raise cash, which I think was around $4 billion for the deal and will ultimately help them pay off their high debts. Speaking of which, according to the Motley Fool, GE's debt to equity ratio is much higher than its peers at around 1.27 versus the rest at less than 0.25. That's pretty alarming. However, GE has been trying to address the elephant in the room. As we talked about before, Jeff Immelt tried to sell assets and cut the dividend many years ago, but more recently, GE replaced the CEO with John Flannery, who famously turned around their healthcare division, and he proceeded to sell more assets and cut the dividend once again, this time by 50%. Still, the CEO was replaced yet again in late last year with Larry Culp, who also continued with the trend of selling assets and cut the dividend yet again, but this time he almost eliminated it, slashing it to only 1 cent per share, a number that is as close as you can get to zero without getting rid of the dividend, since they still want to say that they've been paying a dividend for almost 120 consecutive years. Of course, the growth history is non-existent, but that is still a long track record nonetheless. On the bright side, the dividend cut is estimated to save the company around $4 billion of cash per year, but it was a major death blow to dividend investors who now feel like the stock might be worthless to them, especially if GE can't turn the business around. But besides the bad news, the signing of Larry Culp did give some investors hope, as his compensation is heavily tied to the stock's performance. See, if the share price climbs by 50% by the end of the third quarter in 2022, which by the way, I think it was in the $12 range when this was announced, then Culp would get 2.5 million shares, which could be worth somewhere around $47 million. And if the stock climbs by 150%, then that could be around $233 million. If you combine that with his annual pay and rewards, he could end up making over $300 million, which is a really big incentive to turn the company around. However, that's easier said than done. In 2017, their power segment made up the biggest portion of their revenue, but also accounted for the biggest decline in revenue and second biggest decline in profit year over year, only behind their GE Capital segment, which had lost almost $7 billion. And while aviation and healthcare were performing well, it wasn't enough to make up for the other poor performing segments. In the full year, GE's revenue still dropped by around $1.6 billion, and industrial profit margins tanked from 11.4% to just 5.7%. And thanks to large charges and costs, many of which came from their GE Capital segment, their total cost for the year came in at around $130 billion, and net income dropped from positive $8.1 billion in 2016 to negative $6.2 billion in 2017. That is really bad performance. But what about this past year? What about 2018? Is GE finally turning things around? Well, sort of. Revenues did increase by 3% for the year to over $120 billion, which is very massive, but costs also increased by 9%, mostly thanks to that $22 billion impairment charge that stemmed from their Alstom acquisition that turned out to be a horrible mess, basically meaning that the acquisition is really worth $22 billion less than they claimed it was on the balance sheet, which is also double what they even paid for. I'm not sure if I've ever seen that happen before, but it's definitely not a good thing. Ultimately, this led to net income dropping all the way down to negative $22.8 billion, which is obviously very bad. By the way, you might notice that the numbers for 2017 are different on this report. I have no idea why. Both reports are from their investor relations page, but either way, this is their newest report, so we'll just continue with it. When looking at their segments, the all-important power segment, which is now their second largest business, dropped by 22% in revenue year over year. On the bright side, GE is expected to consolidate to just power, aviation, and renewable energy, and those two other segments did do very well. Aviation is their largest business now, and it rose by a very impressive 13% year over year. Renewable energy also did well, increasing by 4%. You can pause the video here and look at the other segments if you want, but I'm just going to keep going with the video since most of those are either being sold or spun off into new companies. Just keep in mind that the deals being done should raise billions of dollars to help them deleverage. Healthcare alone is expected to take some of GE's debt along with it, and while they were previously planning to sell just around 20% of the new spun off company in a public offering, the CEO has now stated in their conference call that they're willing to sell just under 50% and then give the rest to GE shareholders. So that's actually a much bigger amount that they're willing to kind of IPO there. Now, they've also combined parts of their transportation business with Wabtec and are expected to continue selling out of their positions in both Wabtec and Baker Hughes. All in all, their CEO said that they may be able to generate around $50 billion from the deals to help them pay down debt, which, by the way, $26 billion worth should be due in the next couple years, with almost $50 billion due by the end of 2023. But keep in mind, they do have long-term debt of around like $110 billion. We'll talk about that more when we look at the balance sheet. But again, raising $50 billion from these deals would definitely help them a very great deal, and at least in my opinion. Needless to say, the power, aviation, and renewable energy segments are the ones that really matter, and results were mixed. Aviation is now top dog, and it is still growing by double-digit percentages, but power remains a big concern. Even if we narrow our focus to just the fourth quarter, power still sunk by 25% year over year, which is horrible performance. But to be fair, renewable energy and aviation saw outstanding performance as they increased by 28% and 21% respectively. And GE Capital also improved, growing their revenues by 60%. Quick correction, I mentioned that they were going to keep renewable energy, aviation, and power. I was specifically talking about the industrial side of their business. I'm pretty sure GE Capital would still be around too. But anyway, profits were pretty mixed overall. Capital did improve drastically by around 100% both in the quarter and the year, but power continues to lose money at somewhat close to $1 billion for the quarter, while renewable energy dropped by over 50%, but aviation did impress here again, soaring by almost 25%. Aviation continues to be just a beast for GE. Still, total revenues for the quarter increased by 5% year over year to over $33 billion. Total costs went down by almost 25%, and they even reported a profit on a net income basis of almost $600 million versus a loss of over $11 billion the year prior. And cash flow from operating activities was also strong at $6.4 billion. But this ultimately brings us to their current valuation, where GE stock doesn't look too expensive, at least at first glance. The market cap is less than half the enterprise value, which is definitely good. They have a forward PE of less than 11, which is also good, although that's if you believe the future estimates on Yahoo Finance, since their trailing PE is uncalculable without any profits. But their PEG is less than 2, which is not bad. We usually want that to be 1 or less, but under 2 is still pretty good. Their PS is less than 1, which is great. That's exactly what you want. And even their PB isn't as horrendous as some other popular stocks at less than 3. Again, we'd like that to be under 1, but less than 3 is not too bad. Still, keep in mind that this is a company that is not profitable right now on a yearly net income basis, so I wouldn't be so quick to call this any kind of a value or even a growth stock, at least not yet. But moving on to their balance sheet, if we lump together cash, cash equivalents, restricted cash, marketable securities, and receivables, we get pretty close to $90 billion, which is definitely very high. But the problem is that their debt is at around $110 billion. So for me personally, that's not a healthy balance sheet that I would like to invest in, although those future deals could definitely help them deleverage substantially. So it's something to consider. So to sum everything up, I feel that GE remains a very interesting stock that I personally love to track, but I'm just not really willing to gamble on it, and I still kind of feel like it's a little bit of a gamble at this point. I don't necessarily have a problem with any investors giving GE a shot. I actually like to go against the herd, and if everybody's overly bearish on a stock, I like to give them a chance, or I like to at least research the company and see if there is any value left there, and if investors are being overly negative on the stock, which could be the case for GE. But I just think that if anybody was to invest in GE, you have to understand the risks that are involved. Number one, this is going to be a multi-year turnaround, and it could turn into a very long turnaround. Okay, there's other things that we'll talk about in a second, but this could definitely be a substantially long turnaround for many years. And all the meanwhile, you have to deal with that very high debt, which they are dealing with, to be fair, but there is still a very large amount of debt. And the other issue is the power segment. Are they going to be able to turn the power segment around? Because it continues to perform very poorly. On the other hand, a lot of bulls would argue that their power segment is heavily cyclical, and it's only a matter of time until we see demand go up for their huge, enormous turbines that they use in like gas and coal producing, not producing gas and coal like fired power plants. It's only a matter of time until we see demand for those go up, which might be true, but there's other issues. Like the main issues from the power segment, at least in my opinion, stemmed from the rise of renewable energies. That was a big concern, and that's not really going away anytime soon. So I think that there are still some long-term concerns there. The issue here, I think, is that they need to really restructure the power segment, which, you know, they claim to be doing, but we're just not seeing any positive results yet. We're not seeing it yet. And while they are investing heavily in renewable energies, that segment is completely eclipsed by the power segment. So you really have to focus more on the power segment and try to turn things around there. So they need to improve the efficiency of the power segment. It still generates huge amounts of revenue, and like many people have stated, it can be cyclical. So you just want to be more efficient when you go into that next upward trend. And don't forget, aviation continues to perform extremely well, and it jumped up in profits by over 20% last quarter. And when trying to find projections on where that market is headed, it's difficult to find any information, but I did find this chart here from Statista, and it shows that just commercial airline revenue alone has soared to almost $900 billion worldwide, which is pretty darn significant. But ultimately, what it comes down to for me is that I still see General Electric as a little bit of a speculative stock, because I'm just not sure if they are going to be able to turn around their power segment as much as people are hoping for. Having said that, you know, a lot of the negativity is already, you know, baked into the price heavily. So that does bring down some of the risk, but it's also up over 30% in 2019 already. So if you were buying, you know, at its lowest price, are you selling out now, or are you holding? You know, what are your guys' thoughts on that? If you're invested in GE, are you holding through the next few years and waiting for this multi-year turnaround? Keep in mind, if this is a multi-year turnaround that, you know, is substantially long in terms of years, we might go through a recession. You know, a lot of people are projecting a recession in the next year or two. So how would that affect your strategy as well? It's something to consider, because, you know, I have to figure that a recession would definitely hurt demand for their turbines and their power segment. It would probably really affect their aviation segment as well. So even though they might have a good 2019, you know, do we end up seeing lower prices just in a year or two because of a recession? And then maybe that would be a better time to maybe believe in GE and maybe invest in them, and then kind of rally with them after that. But I don't know. There's a lot of things to consider with GE. I don't mean to sound overly negative on them. It's just that I still see it as a little bit of a spec stock, and because they don't have a dividend, it also makes me much less attracted to them. And I don't necessarily have a problem with investing in at least one speculative stock. But right now, my portfolio, I have NIO as my spec stock, and I'm also thinking about picking up Patriot One, which would also be a spec stock for me. And so then GE would just be, that'd be too many spec stocks for me. So it just does, the stars are not aligned for me to pick up GE at the moment. But, you know, if anything changes, I'll definitely make an update video and let you guys know. But anyway, I'd love to hear your thoughts on this. And if any of you are invested in GE, I'd love to hear your opinion on this as well. I know some of you are invested in GE, so congratulations on the rally here in 2019, up over 30%. It's very strong. And please let me know if you're planning on holding it long term, or if maybe you're cashing out. You know, I'd just love to hear your thoughts on that. So anyway, I will catch you guys in the next video. Take care. Hit the like button if you enjoyed the video, please. And I will see you guys later. Take care. Bye-bye.